Value and growth investing are the two main approaches to stock market investment. While it's not obligatory to favor one over the other, both methods have devoted followers. Understanding these strategies is crucial, as they each come with their advantages and disadvantages. By analyzing the merits and drawbacks of value and growth investing, investors can make informed decisions to suit their individual preferences and financial goals. In this video, we will know more about growth and value stocks and understand different investment approaches. Make sure to subscribe to our channel now and press the bell icon to get regular updates. Welcome to Money Mindset. Let's get started. Growth investing. Growth buyers look for stocks that are worth $100 but could be worth $200 in a few years because the company is growing quickly. If the company keeps doing well, its financial success will depend on its growth and the market's continued preference for growth stocks, which is often shown by a P/E ratio. These growth stocks are also called momentum stocks because they are going up so quickly that more and more buyers want to buy them. But sometimes this rise happens without much thought to the company's core fundamentals, which can lead investors to have too high hopes. When these high hopes aren't met as quickly as some buyers thought they would be, a growth stock can drop sharply. However, if optimism returns, the stock may rise again. Value investing. Value investors are different from other investors because they look for stocks that are cheap now but could grow in the future. Instead of focusing on stocks that are going up fast and are expensive, they look for companies that are trading at $50 but have a real value of $100 right now based on their business prospects. These stocks may not be popular on the market right now, which could explain why they are worth so little. Value buyers think that the market's mood will improve, which will cause the price of the stock to go up. Wes Krill, a senior investment director at Dimensional Fund Advisors, says that value investing is built on the idea of paying less for future cash flows, which can lead to higher expected returns. Warren Buffett, Charlie Munger, and Ben Graham are just a few of the most well-known value managers. Rich people like Jeff Bezos and Bill Ackman, on the other hand, prefer growth stocks. Even Buffett has changed his way of investing in recent years to include growth-oriented investments. Differences between growth investing and value investing. The distinction between growth and value investors is often seen as artificial, with many investors agreeing that it's not always clear-cut. Sometimes growth stocks can be undervalued, and certain value stocks can experience growth. Regardless of their preferred approach, all investors aim to purchase stocks that will be worth more in the future than they are today. Both value and growth companies tend to expand over time, making them attractive long-term investments. As a result, the definitions of these terms can be somewhat ambiguous. Traditionally, it's believed that in times of market greed, growth investors excel, while value investors do better during fearful market conditions. However, according to Blair Silverberg, CEO of Hum Capital, the 2020s are different. Technology companies are experiencing genuine tailwinds, and valuable opportunities can be found by investing in excellent companies at fair prices. In some cases, the disparity between the two investing styles may largely be a matter of perception. The market may overlook a company's earnings growth potential simply because it has been categorized as a value stock, as pointed out by Nathan Rex, Chief Investment Officer at Eigenvector Capital in Stamford, Connecticut. Which style of investing is best rests on a lot of things, since each style can do better in different economic situations. When interest rates are low and predicted to stay low, growth stocks may do better. But when rates go up, many investors switch to value stocks. Growth stocks have done better over the last 10 years and more, but value stocks have done well over the long term. Growth stocks continue to outperform. In the past 10 years, growth stocks have been performing well, largely driven by large tech companies with significant opportunities. Tech giants like Meta Platforms, Alphabet, Amazon, Apple, and Netflix, previously known as FAANG stocks, now dominate the market and have a significant presence in key indexes like the Standard & Poor's 500. Microsoft, another trillion-dollar player, is also part of this trend. During the 5 years leading up to 2019, large-cap growth stocks outperformed large-cap value stocks by a total of 30%. However, value stocks still had a respectable annualized return of over 9%, according to Ryan Johnson, a CFA and Managing Director of Investments at Buckingham Advisors. The surge in growth stocks can be attributed to investors' fear of short-term events and a low-growth economy, leading them to pay a higher premium for companies with potential growth in the future. This was particularly evident in the last decade, when the market favored companies showing the ability to increase earnings in a low-growth and disinflationary environment, as explained by Jeff Weniger, head of the equity strategy at Wisdom Tree Investments. Tech and communication services stocks were winners in the growth category, benefiting from the trend, while energy and financial stocks struggled, typical constituents of value indexes. The pandemic further exacerbated this divide, as tech stocks thrived while traditional companies faced challenges. Low interest rates have also contributed to the appeal of growth companies. Although growth stocks may not always be highly profitable, investors overlook this due to the low cost of money in a low-rate environment. On the other hand, traditional banks face difficulties in such an environment, as the flat yield curve and low interest rates limited their earnings power since the Great Financial Crisis. The disparity between growth and value dynamics shifted in 2022 and 2023, when the Federal Reserve raised interest rates rapidly to combat inflation. This caused investors to move away from growth stocks and favor value stocks for a while. However, as 2023 progressed, investors regained some risk appetite and began welcoming growth stocks again. Value investing tends to outperform over the long term. Dr. Robert Johnson, a finance professor at Creighton University and co-author of the book Strategic Value Investing, says that even though growth stocks might do better in the short term, value stocks tend to do better in the long run. He says that Nobel Prize winner Eugene Fama and Dartmouth professor Kenneth French's research from 1927 to 2019 shows that value stocks have done better than growth stocks 93% of the time over 15-year moving periods. But over shorter periods, value stocks may not do as well as growth stocks. The same study shows that value stocks only beat the market 62% of the time over 1 year. During market downturns, it's important to be careful when buying in value stocks. Some value stocks may have problems that won't go away, while others may be going through temporary setbacks or have temporarily lost favor with the market. People often call these stocks value traps because buyers may mistakenly put their money into cheap stocks that don't do well. Growth stocks also have risks, just like value stocks. Investors in highly valued growth companies may lose money if these companies can't keep growing as quickly as Wall Street wants. The age-old debate between growth and value stocks will continue, but evidence shows that value stocks tend to perform better in the long run, despite growth stocks grabbing attention in the news. For those investing in individual stocks, it's wise to stick to fundamental investing principles. Alternatively, considering a reliable index fund can reduce the risks associated with individual stocks. That's all for today. I hope you have found this video interesting. Don't forget to like and subscribe to our channel and follow us for more amazing content. Thank you.